Hi, Charles Sizemore, Chief Investment Strategist of the Freeport Society. And well, we can't say he didn't warn us. When I first spoke to my guest today, Mr. Jeff Clark, he warned us that, this was back in January, by the way, he warned us that the next 100 days were going to be some of the most volatile we've ever seen in our careers as investors, but also some of the most profitable. So how'd that work out? Jeff, thanks for being on.
Thank you for having me, Charles. It's great to be here.
Yeah, so your call about volatility spiking after January ended up being spot on. There were quite a bit that happened over the last couple months, not the least of which was a trade war. So you called that spot on. I do know your team actually gave me a few bullet points here about how you traded during that time period, by the way. You did have 18 winning trades, of which 3 were triple digits. So that's not a bad track record during a time when most of the world was running and hiding.
No, that worked out pretty well. You know, we got off to a kind of a slow start, to be honest with you, though. We were obviously expecting volatility. That wasn't really a hard call to make with a new President Trump, because we know what happened the first time around. But the volatility was actually a little bit different than it was the first time around. You know, back in 2017, we had a situation where, Mr. Trump would take a position on something, and that position would last for several weeks. So you could make a trade based on a maturity of maybe several weeks down the road. That didn't happen this time around. Mr. Trump would take a position, and then he would change his minds, hours or days or maybe a week or two later. And so we had volatility that was much more intraday than we were accustomed to. So, for example, I started off the first 100 days. I think I had a bullish trade on Peabody Coal and a bullish trade on Bitcoin, and both of those started off in the right direction. But we wound up taking losses on them because the mood changed, or the direction of that changed. So we did a really quick pivot, and the next 18 trades, as you pointed out, the next 18 trades we did were all profitable, with, I think, 3 of them were triple digits, and I don't know, the rest of them were double digits. So we did pretty well, but it did take a little bit of an adjustment midway.
It's funny. The news cycle, shall we say, has gotten shorter, right? So things Definitely. That would have been in the news for weeks, if not months, maybe hours now. It really is moving faster than. See, I've noticed this over the years. This didn't happen in a day, right? But the speed at which it's changing is surprising even to me. I've been watching this for years, and it's even taken me by surprise. So
the headlines are certainly shifting back and forth a lot more frequently, but the end result to everything, nothing's changed. Nothing's happened, but the headlines keep moving back and forth, and it's the headlines that the market's paying attention to.
Now, the question remains, of course. So we had this spike of volatility. That's well known. We've been there. We've done that. The question, of course, is what happens now?
Yes.
And I made the joke that, we all saw Fight Club 1,000 years ago. And The first rule of Fight Club is we don't talk about Fight Club, right? Well, that brings me to the taco trade. And of course, the taco trade is, Wall Street speak for Trump always chickens out. And what that is in reference to is he'll throw down the gauntlet here, getting tough with a tariff announcement, really ramping up the pressure. And then when it looks like Wall Street's about to crack or has started to crack, then he backs off, right? Now, you could say that's part of his strategy. You could say he's reacting to events. That's really not relevant. But the takeaway was whenever things start getting too rocky, Trump backs off. And so you should always buy the dip. Now, my fear, of course, is, in the same way we don't talk about Fight Club, the first rule of the taco trade is you don't tell the president about the taco trade. Because as soon as you do, now he feels like he has to be extra tough to prove that he won't chicken out, right? So if there was if he was inclined to start tough and then back off, now he's going to have to go tougher and potentially not back off. So, and then beyond that, a lot of his trade agenda has, of course, also hit snags in the court. And so the market has this kind of sense of, maybe it's a false sense of security that, well, maybe the trade war is over because the courts are slowing it down. I think it's just as likely the exact opposite will happen. This will push Trump to be even more aggressive and really come out gunswinging. I'm mixing metaphors here. Just coming out swinging, guns blazing. And with whatever volatility may come from that, yeah, how do you see that playing out?
Well, I think you're spot on with that. But it really doesn't matter what occurs ultimately. All we're looking at is trying to take advantage of an increased volatility marketplace. Whether that volatility encourages stocks to move higher or lower doesn't really matter to me. I'm really just looking for situations where things have gotten too extended, too far in one direction or the other, and I'm just going to play the snapback. Because when you have a market that is headline driven like this one, and you have any number of catalysts that the president can go to that can shift the mood of those headlines, bearish or bullish, you have that potential for increased movements in the marketplace and increased expanded conditions and increased snapbacks. So really, it's an ideal setup for what we call a reversion to the mean strategy. It's a very chaotic environment where things get really overbought or really oversold. And if you look at it like a rubber band that is just stretching and stretching and stretching, all I'm doing is looking for a trade where I think that rubber band is going to snap back. They always do, or they always seem to. And particularly in this market environment where one headline can push things into overbought conditions, and then a day later it snaps back and goes the other direction. That's why we have so many opportunities to trade, and we've been able to trade. And I think that is the sort of volatile environment we've got facing us. And again, it doesn't matter if you're bullish or bearish. I'm not trying to spew a negative feeling about the market. And I'm not trying to pump up a bullish feeling about the market. I'm just looking for those opportunities where things have gotten a little too fearful or a little too greedy and bet on them reverting back to the mean.
Yeah, I like that because right now the trend is a little bit uncertain, right? And not just the stock market trend, just the trend of the economy, the trend of policy. It's all somewhat in flux. And so in an environment like that, it's not super easy to make big bets, big, potentially long-term bets. That's really, really hard in an environment like this.
Yeah, I would argue it's probably a mistake to make long-term bets or even intermediate-term bets. As I mentioned, a lot of the trades that we were profitable on over the past month or two have been based on a lot of the intraday swings. So the average trade that I've had, I think, is about 4 days. So some of those positions, we're in one day and we're out 2 or 3 or 4 days later. That's unusual.
Another thing that was interesting, Jeff, is we were talking offline, and correct me if I'm wrong, but while the market was actually ripping higher kind of post Liberation Day, you made some really good trades on the downside.
That's correct. Yeah. For example, last month in May, we had the best May since 1990, we're told. The S&P 500 was up 6%. But in Delta Report, Delta Direct, which is a daily series that we offer to Delta Report subscribers, we did 4 trades. All 4 of them were profitable, and they were on S&P puts, which, in hindsight, seems a little bit unusual that the market had the best May in 30 years, and we profited for 4 out of 4 times on puts. So that's what I'm talking about when you have the sort of volatility that we've seen, and you have the sort of extended conditions that this particular president can encourage. You have those opportunities that come up.
Yeah, that's to your point. It's even though the trend was up throughout the month, you're not playing the trend. You're playing the snapbacks. You're looking for cases where that rubber band got a little too stretched and it snaps back. Whether that's it stretched too high on the upside or stretched too low on the downside, it snaps back. So that's,
exactly. And like I said, the S&P 500 was up a little over 6%, but if you add the combined returns of those 4 put trades, we were up 120%. So, it's possible to do even better trading the intraday fluctuations.
Well, so let's take a step back and talk big picture here for a minute. So, I mentioned that I don't know that the trade war is over yet, and we may have a decent bit of volatility, coming just due to that. But I know you've been looking at something else. There is something else that is deeply concerning to you. Well, why don't you share that with us?
Well, yeah, it's a little concerning because I feel almost like I'm watching a magic show. The whole world, the magician's up there and he's talking about tariffs and trade wars and all this, and he's diverting your attention from what happens to be going on over here behind the curtain. And what's behind the curtain is what's going on in the Treasury bond market. Last week, the yield on the 30-year Treasury hit a 20-year high. It reached a little bit
and
above
Jeff, let me
5%.
point out, for not everybody is a professional trader. When yields are hitting 20-year highs, that means the prices are dropping. When yield goes high, price goes low in the bond market.
That's correct. The bond market's been selling off, and interest rates obviously have been going up. Not the short-term interest rates that the Fed controls, but the long-term interest rates, which are what the bond market controls. And the bond market is supposed to be smarter than the stock market. So it's important to pay attention to what's happening in the bond market. The curious thing about this is last September, I started talking a lot about the yield curve. And remember, a couple of years ago, the yield curve inverted. What that means is the short-term interest rates were higher than long-term interest rates. And that's abnormal. That's not supposed to happen, right? When you give your money to a bank, you've got it in a 30-day CD, you get this rate. You got it in a 30-year CD, you get a little bit higher rate. That's normal. What was happening starting 2 years ago is that inverted, so that you were getting less money on your 30-year CD than you would get on your 3-month CD. Like I said, that's not supposed to happen. And back then, a lot of folks, you turn on CNBC or Bloomberg or Fox Business News, everybody was worried that that's what points to a recession. My argument 2 years ago was it's not the inversion that points to a recession. It's when you go from an inverted condition back to an upward sloping yield curve. So when you have short-term interest rates that are higher than long-term rates, and then you go back to normal where higher long-term interest rates are higher than short-term interest rates, that's when you get the chaos moves. That's what happened last September when the Fed lowered short-term rates. They actually spiked long-term rates. And if you look at a yield curve, it's gone back into an upward slope. That's only happened 4 times in my adult lifetime. One was in 1992, one was in 2000, one was 2008 or 2007, and one was right before COVID in 2020. All of those occurred right before a very chaotic situation in the stock market. All 4 of them. So this is the 5th one in my adult lifetime. So I'm thinking we're probably due for that. And what's interesting about this one is this one lasted for 2 years. This was the longest duration of an inverted yield curve. And it was the deepest inversion of an inverted yield curve. So it seems highly unlikely to me that was, or all the chaos that we're due to see from this was over on Liberation Day when we had the 1 month swoon in the stock market. It doesn't seem to me that it makes a whole lot of sense that we've corrected all of those excesses at this point. So if you look at it now, I'm thinking long-term interest rates are ready to spike higher. If you look at a chart of long-term interest rates going back 40 years, we had a 40-year bear market in interest rates, 40-year bull market in bonds, if you will. Starting about 2022, we started to see that tick up. And it was last September when if I had a chart up here, I could show you where it broke above a particular resistance level.
Sure.
So in my opinion, Treasury bonds went into a bear market in September, and that's just the start. Bond markets, bull and bear markets in bonds last a very, very, very long time.
Well, Jeff, I know the Treasury was concerned enough about this that they've openly talked about not having auctions for longer term bonds for a while, or having smaller auctions. So they are concerned enough that, yields are rising. We probably don't want to flood the market with more inventory. That's just, that's going to make a bad problem a lot worse. So when the Treasury is already telegraphing that they may be pulling back on new issuance of long-term debt, that tells you something.
Yes, but the problem with that, sadly, is we have a $36 trillion debt, national debt, $36 trillion. $9 trillion of that comes due in the next 12 months. So a quarter of our long-term debt is going to have to be refinanced in the next 12 months. That's not going to be at cheap interest rates, right? Even the short-term interest rates are higher than where they were a couple of years ago. When you look back at the 30-year bonds, in 2022, they were 0.5%. What they ought to have done was refinance all of their debt at 0.5% and not worry about it for another 30 years. But nobody was smart enough to do that.
That's going to go down in history as probably the dumbest mistake any Treasury Secretary in the history of the Republic made, was not refinancing the entire national debt when we were at COVID lows,
Exactly. Which is why I think it's important that you have business people in charge of these sorts of things. But we'll save that particular discussion for a later date. But the immediate concern that I have is so much of that debt is coming due and has to be refinanced. So much of the new budget bills that are being proposed require issuance of even more debt. And then when you look at it put the government out of the way, look at it from a corporate standpoint. The past several years, corporations have taken on a whole lot of debt, and they've used that debt, the proceeds from that debt, to buy their stock. So why have stock prices been able to sustain, historically expensive fundamentals? Because the companies are buying it back. That's not going to happen in the future because interest rates are too high to do that. So that particular demand for stocks is no longer in the market. Individuals. Remember, we talked about this before we went live here. We talked about how it used to be possible where you could go and refinance your mortgage, take out some money and go buy a house or a car or a boat or something else.
Furniture, whatever.
Anything. But you can't do that now because you're not refinancing at a lower rate. We had 40 years where people were able to go to the bank and refinance their mortgage and take out money at a lower rate so that their monthly payment was exactly the same as it used to be. They were just able to borrow more money to go do all these other things. Now you can't do that because now your mortgage, it's not 3% anymore. We're at 7%. So refinancing now, it's not available. So that cash is no longer there. That has to have some level of contraction in the economy. That's going to show up in the economy.
Every dollar spent on debt repayment or debt service is, well, not even debt repayment, mind you, just the interest, not even paying down the debt, mind you, just servicing the existing interest expense. Every extra dollar spent on that is a dollar not spent elsewhere. It's a dollar that's not spent on a coffee at Starbucks. It's not spent on a new pair of shoes. It's not spent on new furniture, new clothes, whatever. So that, I agree that will sap demand out of the economy. It already has.
And just to answer the question that often gets asked when people talk about this is they say, well, heck, we've had a debt problem and a deficit problem for 40 years, and it's never mattered. The national debt under Ronald Reagan in 1982 was less than $1 trillion. Now we're at 36 trillion, almost 37 trillion, and it hasn't done anything. We haven't had a negative effect to the economy from that. The point that I'll make now, what makes a difference is interest rates are no longer falling. Interest rates are going up. They've been falling since 1982. Now they're going up. So you no longer have that ability to refinance and take cash out. That's what makes it different. That's if you go back in time and you look at what happened in the late 60s and the entire decade of the 1970s, that was not a stellar economic period. And I have a feeling
most people forget that the stock market went nowhere between 1968 and 1982. That was a lost decade and a half.
That's right. And if you were a buy and hold investor, you lost a decade. But you had opportunity to trade. You definitely had rallies during that period and you had declines during that period. That's why I like the idea of folks learning to trade right now or learning to move in and out of positions a little bit more frequently than they might be accustomed to in a bull market.
Yeah, I've made a similar argument over the last several months that in an age of chaos, you probably have some stocks you never want to sell. They're long-term positions, and that's fine. But the biggest change you should make is just be willing to be more of a short-term trader because the longer-term trend is going to be more uncertain. It's not as easy to buy and hold when stocks are starting at elevated prices and you're in a less favorable interest rate environment. It's just not the best macro environment to be doing that. But it's a fine environment to be short-term trading, to play those bins and twists.
I think the best strategy to use in that environment is a reversion of the mean, where you're really just waiting for extended conditions one way or the other and playing for that snapback.
Yeah, I would be inclined to agree. So, Jeff, I know you're going to be giving a presentation. Can you give us a few details on that?
Sure. It's next Wednesday, Wednesday the 11th at 10 a.m. Eastern Time. It's called Countdown to Chaos. That wasn't my headline, but it sounds a lot more sexy than reversion to the mean. So the marketing guys said, let's use this. I'll talk about the strategy. I'll talk about the conditions that I look for to implement that strategy. I'll talk about I use options. And a lot of times when we mention options, people get a little bit wigged out because they see danger in gambling and all this. I use options the right way. I've been doing this for 40 years. I don't do stupid things with options. I use them to reduce my risk, which is what an option is really designed for. So rather than going in and putting a lot of money into a stock, I'll take a little bit of that money and I'll put it into the option market, keep the rest of the money nice and safe, and I'll play it that way. And we're able to generate consistently strong returns, doing better than what you would otherwise do in the stock market. And I'll explain exactly how we do that. So the idea behind the webinar is to talk about what I see coming in the economy and in the markets over the next year, 2, 3 years. Talk about the strategies I think will work out best, which will be, I think, a reversion to the mean. Talk about how best to use options for it. And I'll talk about some individual sectors and maybe even some individual stocks that folks can take advantage of right now in situations that exist that I think could pay off over the next several weeks.
Yeah, Jeff, that's great. I mean, the beauty of options is that you can define your risk. If you do it the right way, as you said, if you do it responsibly, you can control exactly how much risk you're taking to a degree that's really hard to do in stocks or futures or other instruments. With options, you really can contain your loss.
In the option. Sorry, I didn't mean to interrupt you there. Where people make mistakes is in the option market is they tend to over leverage. So, let's say somebody wanted to buy 100 shares of Palantir, which I think is around 130. So that's a $13,000 commitment. So you're putting $13,000 into the stock to buy 100 shares. I could go to the option market and with $400 control 100 shares of stock. So you can take $12,600, put it in your money market fund, leave it there, and take $400 and risk it in the option market. The most you'll ever lose in my situation is that $400. Obviously, you could lose a lot more if you put $13,000 into the stock. Where most people make their mistake is they don't put $400 into an option. They have $13,000 to spend on the stock, and a lot of times they take the entire $13,000 and put it into the option. That is significantly over leveraging your account. Now, it's okay on certain occasions where you might buy 2 options or 3 options and maybe have 2 or 3 times the leverage that you would have in the stock market. But 13,000, all that you would put in the stock into the option market is stupid. And that's where people wind up blowing up their accounts. They might get lucky once or twice, but ultimately you wind up blowing your account and then swearing off options forever. If you use options the right way, though, as they were intended, which is a means of reducing your risk, you can do very, very well and sleep very well at night and not worry about it and actually do better than owning the underlying stocks themselves.
Well, I like to hear that. In the age of chaos here, anything we can do to help us sleep better at night is very welcome.
Yeah, and I don't, like I said, I'm not trying to scare folks with bearish premonitions. I actually enjoy volatile markets. I enjoy down markets as well. One of my best years was 2008 when the stock market had a hissy fit. But what I love about it and what I try to talk to folks about all the time is anybody can make money in a bull market, right? It doesn't take a lot of intellect. It doesn't take genius. You just simply buy stocks. A
monkey throwing darts at the Wall Street Journal can make money in a bull market.
That's right. And sometimes even better than those of us in the business. But the tide lifts all boats, right? So that's a bull market, not a problem. But the decisions you make in a bear market can make you wealthy. And that's what I want to get people to anticipate a bear market condition and to look forward to the possibility of being able to buy stocks at generational low prices. Think about it. If you go back in time and buy stocks in 2008, that was an absolutely phenomenal time to be a buyer of stocks. It was a horrible time to own stocks, but if you were heavy in cash and were able to buy at that point, that was fabulous and you did very, very well. That's what I'm trying to get folks to understand is a bear market is not something to be feared. It's actually something to look forward to because it allows you to deploy capital and acquire very good assets at cheap prices.
Yeah, it's something to look forward to if you're prepared for it. And that's right. What you aim to do.
That's right.
Well, Jeff, thanks for being on. We're going to put a link under the video here so that people can learn more about your presentation. And I strongly encourage everybody listening to check it out. I know I will be. So, Jeff, thanks for joining us.
Great. Thank you for having me. I appreciate it. Thank you, everybody, for watching.
To Life, Liberty, and the Pursuit of Wealth, this is Charles Sizemore signing off.